I still speak Portuñol. So my name is Julia Figueiredo. I'm Brazilian. I've been with the bank for a year and a half now. I'm head of Latin America, so which means I work with all the startups and funds that are based in Latin America, mainly Brazil and Mexico, but we also have companies in Argentina, Colombia, and Chile. They are banking offshore, using that structure that Dan and Christine talked about yesterday. This is clicking by itself. Okay. Okay, so and then I'm done. Thanks.
Bravo. That was brief.
Hope you all got it. Let's try again. Okay, who here knows, or maybe who here doesn't know of Silicon Valley Bank? Can you just show your hands? You don't know? Okay, one. Everybody knows what Silicon Valley Bank is. Wow.
Yeah.
Okay. So we've been on the market for 36 years. I'm going to go straight to the point. We are the Bank of the Innovation Economy. We've been working with startups and funds for almost 40 years now. This is some of the clients that we work with in Mexico, Yalo, Clip, Credit Justo. Some of the Brazilian startups that are just moving to Mexico, Loft, iFood with Cedelantal, Nubank. The major VC, OVP, Angel Ventures, probably you guys are familiar with these brands. I just wanted to give an idea of how big Silicon Valley Bank is in the US. So today we bank 50% of all the venture-backed startups in the US and almost 70% of all the funds. And on our loan portfolio, 5% is for startups. I think we have about $3 billion in venture debt for startups in the US. So, what's venture debt? Venture capital is very important because startups is a high-risk, high-reward business. So venture capital, it's very important to finance that growth on that stage. When a company is acquiring more customers, the technology is more stable, and the company is growing, that's when venture debt can be very useful and important for that company. So this graph shows a little bit of when you should be taking venture debt. So either you take venture debt a little bit before the equity, with the equity round, or 1, 2, 3 months after the equity round. That's typically. Then it gives you runway and money and time to get to your next valuation so you can raise more equity. So it's very important to note that venture debt is used as growth capital. It's not as a last resource. Your company is desperately needing for money. It's to increase and empower your growth. Usually, a company should take 20 to 30% of the equity round in venture debt. The first 12 months of venture debt, the company will be paying only interest, and all these numbers are typically, and each company is its own deal. We don't have a one-size-fits-all deal, so whenever a company comes and talks to us, we try to understand their business, where they are, where they're going, the projections. So this is just a guideline. So after the 12-month period of only interest, there's an amortization period within typically 36 to 48 months. There are no financial covenants, but there are fees, interest rates, and a warrant component that will allow both party interests. So sometimes an equity kicker on the deal. So what's the difference between venture debt and equity? So venture debt, it's a lower equity warrant. With equity, the VCs, they own a significant stake of your company. The balance for venture debt is paid over time. As with equity, you don't need to repay the money. There are no board seats required for venture debt. In equity, there is board seats requirements. No financial requirements, but it is important, and the company has to report to the lender every quarter. And for equity, there are no sorry, no covenants, but there are board members that will be there with you the whole time. And both monies, both equity and debt, you can use for any purpose. We want to, for venture debt, we really want to stress that is to empower the growth on whatever your company needs. So when does it make sense to raise venture debt? And some people argue that venture debt is not the best name for the product. Maybe it's growth debt, because we really want to see businesses that are already they already have $4 to $5 million in revenue. So you can see it's not a super small startup. Should have raised equity before sometimes, and we've done deals with no equity, no venture capital before, but it would be good to have venture capital. And here in Mexico, as I mentioned, in the US, we have a big network of VCs, and we do have a big network of VCs in Mexico too. So if you're raising from a local VC like OVP or Jaguar or any Igna, Dalus, we will look at the deals as well. We're not only looking at Sequoia and Excel. So raising equity beforehand or at the time. And if you want to purchase fixed assets or acquisitions, that's just to say it's to empower your growth. And when it does not make sense, it doesn't make sense when you're too small, your business is not proven, you don't have strong revenue, you're not growing. We usually want to see 50 to 40% growth year over year. And when you're using this money because you desperately need to breathe, that's not when we're going to lend money for you. Weird. Okay, so this is another graph that explains kind of the same graph as the first one, but you can see more clearly here. So you get venture debt, then you have this time where you're growing. That's where we want to be. We want to grow with you. And then after you grow, we're going to get private equity, private debt, and bank debt, which different than Silicon Valley Bank, which is regular big banks. So for 25 years, Silicon Valley Bank has been doing venture debt in the United States. We've been trying to get a product to Latin America for over 5 years. We're almost there. We are doing a partnership with Partners for Growth, which is an affiliate of Silicon Valley Bank. We were investors on the first 2 funds. Most of Partners for Growth deals come from Silicon Valley Bank and from our clients. So we're working really tight with them. And they are coming to Latin America. They are already looking at deals. So if you want to talk to me after the session or after drinks at happy hour, I can talk more about each specific case. But this is typically what we would go for. So a loan size anywhere from $1 to $15 million. Ideally, $3 to $5 million is where we want to be. $5 million plus in revenue.
Oh.
And done.
3 to 5 million.
Okay. So VC or not VC backed. Again, usually go after the VCs, but we will look at deals with no VCs. Their financial options, term loans, revolving lines of credit. So if you think you need $10 million in venture debt, but you only need $2 million for the first 6 months, we will give you only $2 million and then an $8 million line of credit, so you don't pay interest over the $10 million, just the 2. So we do really want the companies to grow, and we will look at each case separately. Revolving debt, so there are very different options. We just need to see what's best for you, and we'll price for the risk. So the requirements, I think I keep saying the same thing over and over again, but yeah, revenue growth, secured collateral, and clear, you don't need to be profitable. Well, yeah, the company doesn't need to be profitable, but a clear path to profitability. That's what I have for today. Follow me on Twitter and Instagram. Any questions? Comments? Oh. Who has a microphone?
I can shout. Just what sort of rates are charged on your debt facility?
Easy
I
question.
told you this question you weren't supposed to ask. No. So in the US, it's 6 to 9%. Again, it depends on the deal, the size, the company, the VC. In Latin America, it's going to be more. We are still pricing. We just issued our first 2 or 3 term sheets. So it's going to be more, and it's going to be around, I'm afraid to say, but around 15 or more. It depends on the company. What type of collateral are we taking? So usually, if we're we go after a round with a VC. The VC, it's mainly like our guarantee that the company has cash flow, and we are the first, the senior lender. We are always going to we're always going to be the senior lender, but because the companies sometimes don't have a lot of collateral, IP is one of them. But we wouldn't shut your IP if you can't pay 1 month, so that's all negotiable.
Would you look at, say, mezzanine for a fintech lender?
Sorry?
Would you look at like mezzanine debt for a fintech lender?
We do mezzanine debt. So the question is, would we look at mezzanine debt for a fintech lender? Not for Latin America, probably, but our team in Boston does mezzanine debt.
Julia, are there any criteria along services businesses and products businesses in terms of annual recurrent revenue, or would you still do business with services companies?
So let me see if I got it right. You're asking if there's like a difference between if it's a service business or if it's a product business.
Right.
If we have any problem with different business models?
Yeah.
Yeah, no. So the only thing is it has to be tech. We won't lend money to blockchain and crypto, and it has to be tech. That's basically it, any tech. No more?
For getting a $3 to $5 million lend, you have to have from $3 to $5 million in venture capital, or what's the rate on that side?
So the question is, if you want $3 to $5 million in that, if you need to have $3 to $5 million in VC. No. So usually we like to go after a VC round, an equity round. We would analyze companies without equity round. The most important part for us is revenue. So you have to have revenues $5 million and up and growing 40 to 50% year over year. Question? No.
Very clear.
Cool. Thank you.
Thanks again for all of the support for Silicon Valley Bank, not only for the conference, MITA TechTalks, but also for the whole ecosystem in LATAM. So really been great bringing investors down to the ecosystem that had not experienced, and I think like a lot of people who've never been here before, once they sit in this room and they see all that's going on, they get really excited about what we have in our tech innovation community. And Julia and Andy have been huge supporters and promoters and really helping share that spotlight too, so thank you for that.